Hey folks, Josh here with Presidio Advisors. I work with millennials who have equity comp, and a lot of millennials with equity comp are also interested in real estate. And so today we're answering the question, I'm thinking about moving and I want to know, should I rent out my primary residence or should I sell it? And so the situation that you can think about that we're in is you bought a house, let's say for $500,000. You bought it 6 years ago. You've been living in the house. It's been a great house for you, but your family's expanded, you guys need a backyard, and so you're going to be moving. And the question is really, what do you do with this property that you bought 6 years ago? Do you hold on to it, rent it out, or do you sell it? And specifically, the calculus that we're going to be looking at is around the capital gains exclusion. And what this is in reference to, and I'll open this up here, is there is a section of the Internal Revenue Code that says that if you are a homeowner and you have lived in this and it's your primary residence and you've been living in your primary residence for 2 of the past 5 years and you've owned this place for 2 of the past 5 years, you are eligible to exclude a certain amount of appreciation of that house from capital long-term capital gains tax, which could be potentially really, really impactful. And the thresholds for this amount, for this section of the code are $500,000 if you're married, meaning if you bought a house for $300,000 and it's now worth $800,000, the government will allow you to exclude that full $500,000 of appreciation from long-term capital gains taxes. And if you're single, that rate is half. So it's $250,000 if you're single. So in this case, let's assume we're married, we've got kids and a family, and we bought the house for $500,000. It's now worth $800,000. And we are eligible. So we've lived in the house for 2 of the last 5 years. We've owned the house for 2 of the last 5 years. The government allows us to exclude that full $300,000 of capital gains from long-term capital gains rates. And so what that amounts to in terms of cold hard cash is $56,400 saved. That is money in our pocket that we can go invest, we can go spend, we can do whatever we want. And so the math that we're going to be looking at today is around this capital gains exclusion. Particularly, does it make sense to take this capital gains exclusion and run, sell the house, take it and run? Or does it make more sense to hold on to the property and to generate a continuous stream of rental cash flows? And kind of how does that math play out? So that's what we're going to be looking at. The thing that I want you to take away from this video is that if your house has appreciated significantly, the odds are that the math will show that it makes more sense to take the capital gains and run rather than renting, relative to if your house hasn't appreciated all that much. Then there's less of a capital gain exclusion, and so the math will lean probably towards continuing to rent out the property. However, this is just the financial, component of it, and there's a huge qualitative aspect of this as well. Do you want to just continue to own this home and pass it down to your kids and hope that it stays in your family for years and years? I mean, that is you can't put a number on that. Do you even want to be a landlord? Do you want to hire a management company and deal with all the hassle of renting out a place? That's also a qualitative aspect. So obviously, there's more to it than just this spreadsheet, but this can help us run some of the numbers. So let me open this a little bit and close this. And let's assume that you want to see what the numbers look like if you were to actually rent and then extrapolate that annual cash flow out and see how long it takes to actually recoup relative to the capital gains rate. So again, these are the assumptions that we're making. Your house is worth 800,000. You bought it for 500,000, and we've put in some assumptions on what you pay aside from just your mortgage. And then we've also made some assumptions of what you can generate in terms of monthly rent. Let's assume that it's a long-term rental and maybe you get $4,000 a month and you've got some other assumptions baked in here. So what the numbers look like is this. So you bring home 40, you're bringing home $41,280 in rental income, but you're also spending a lot of money because you have not just a mortgage to pay, but property taxes, insurance, potentially an HOA, annual maintenance. So it adds up. And I have seen people make the mistake of, oh, 41,000, that's great. It's almost double what our mortgage is. And then they forget that, oh, there's actually a lot more to it than just a mortgage. So don't forget that. You need rental income to cover everything, not just your mortgage. And then because you are generating rental income, you're going to file a Schedule E. And what's interesting about this situation here is that your income is going to be 41,200. Your deductible rental expenses are actually more than your rental income. So your adjusted gross income for your rental property is technically zero, even though you're bringing in cash. So it's positive, it's cash flow positive. So that's a nice benefit. And maybe you want to see, okay, does this make sense? If I'm bringing in this cash and kind of over the long term, what does it look like? So then we move into this. Okay, if I did want to continue to rent, how many years would I need to rent out this property before I recouped that 56,400 that I could have had if I had sold it, plus whatever amount we could have generated if we had taken this 56,400 and put it into let's say, a risk-free treasury bond. So down here is where we're assuming kind of our rate of return, the opportunity cost essentially. And so, you have that 56,400. It could be generating 3.9% annually. And you take that and you compare it to your rental income and cash flows. And what you can see here is that you need to continuously rent this property for anywhere between 16 and 17 years. So let's call it 16 and a half years before it's a better financial decision to have rented this property than to have taken the capital gains, the capital gains exclusion. That's a long time, and I think people often don't quite think that it's going to take this long. And so if you're not willing to be a landlord or to have this property for, call it 16 and a half years, then it's good to run these numbers and to see that and to kind of see how it plays out. Now, one thing that we were talking about earlier is that this is really heavily dependent on how much your house has appreciated. So if we run a slightly different scenario here, let's say instead of your house, skyrocketing in value to 800,000, it's now appreciated, but it's only appreciated to 600,000. And accordingly, you can't command the same rent. So let's now assume that the rent that you can command is 3650. So your house has only appreciated $100,000 versus your purchase price. So again, we have kind of the numbers here, the cash flow here. At the end of the day, you're bringing in basically the same cash flow, even though your house is worth $200,000 less and you're not bringing as much rent. But what's really interesting here is if we look at this capital gains exclusion, it is significantly lower than what it was when your house was worth $800,000. And so the opportunity cost is also a lot lower, which means that it makes a lot more sense to rent than it does to sell the property and take the cap gains. And so in this case, the math would say that between 5 and 6 years is when renting would turn into a better investment than taking the capital gains. So I think these are just kind of interesting to note, and I'm always happy to play around with these different scenarios with folks. Again, if this was 800,000 and this was 4,000, it totally changes the math in terms of like, does it make sense to take the capital gains exclusion and to sell the property? So always just kind of interesting to run the numbers. And again, you have to pair that with the qualitative, but hope this is helpful. You can always reach out to me with questions. I'm Josh. You can email me, josh@presidioadvisorsllc.com. or you can find me at presidioadvisorsllc.com. Hope this helps. Thanks and take care.